Good morning. My name is Jim Barrett. I'm responsible for the institutional business at Barron Capital. Welcome to our 31st conference. Thank you very much for being here, and most importantly, thank you very much for being our clients. This panel specifically, we're going to talk about small cap stocks, and we have the managers of two very successful portfolios, the Barron Discovery Fund strategy, and then also Cliff Greenberg and David Goldsmith from the Barron Small Cap strategy. I think if you look at performance on both of these funds, long-term has been excellent. I think we're talking about alpha generated on an annual basis of 400 basis points, so very successful in terms of applying the Barron strategy to the small cap side. At this point, I think it makes sense to just have the panelists introduce themselves, give a brief introduction, and then we'll take your questions.
Hi, everyone. My name is David Goldsmith. I'm the Assistant Portfolio Manager for the Barron Small Cap Fund. I've been at Barron for 18 years now.
I'm Cliff Greenberg. Thanks, everyone, for coming. I'm the manager of the Barron Small Cap Fund. I've been at Barron for 27 years and have run the fund for that period of time. I also serve as the co-CIO of the organization.
Hey, Randy Gwirtzman, co-portfolio manager of Barron Discovery Fund. I've been at Barron for 22 years, and the fund's been up for 11 years.
Laird Bieger, co-manager at Barron Discovery with Randy. I've been at Barron for 24 years, and it's nice to see some longtime shareholders in the audience.
Great. Why don't we get started with Cliff? Cliff is a Green Bay Packer fan. I am from Chicago, but we get along quite well professionally.
I do have, he's going to owe me lunch after this weekend, I'll tell you.
Cliff, maybe you could say a few words about the market and the environment we're seeing right now, and perhaps talk a little bit about the future.
Sure. Just to quickly summarize, our funds are doing well this year. Both funds are up in the high teens, which is, we think, good absolute and relative performance. Small caps started the year very much out of favor. They've been out of favor for the last handful of years. The funds have kind of done well because we own some one-off companies that have great results, and their stocks have followed them up. So our good performance primarily has been because of good stock picking. The market and small cap stocks have acted better since right before the election and post-election. The stocks have acted better because there's an expectation of faster growth and a more pro-business environment, which is good for our smaller companies, many of which have kind of struggled with growth over the last couple of years. So the initial reaction to the new administration was very positive for small cap and for our stocks also. Now there's a little bit of concern about maybe inflationary effects because of some of the potential future policies or some chaos with some of the government nominees for the cabinet. So I imagine it will be a little rockier from here, but generally, we're pretty optimistic that we've lived through periods of kind of poor performance in our asset class, slower growth than normal. We expect that growth is going to get better, and that will be very good for our stocks. And we start at a point of a relative undervaluation and cheap stocks. Laird, maybe you could just add to the starting, where
Sure.
How small caps are valued.
Yeah, it's been a very tough few years in small cap. Our joke is if you go back to early 2021 when our benchmark, the Russell 2000 Growth, peaked, and look to the end of the third quarter, we were down, meaning the small cap benchmark was down a little over 13%, and at that same time, the large cap benchmarks were up 56%. So, dramatic difference in performance. My joke is that Randy and I would be sitting on one side of the office, and we'd be looking over at the large cap managers and seeing confetti going off every day as they hit all-time highs, and it was pretty depressing on our side of the office. So it's been challenging. So first off, we've seen a lot of underperformance, but that's the opportunity, which is there will be a reversion to the mean. When we look at valuations in small cap, they are today trading at a discount to large cap. Typically, they trade at almost a 4-point premium on a PE basis to large cap. So that's another reversion to the mean opportunity. And then lastly, The piece that I find most interesting, and one that I don't think most investors are aware of, is how under-allocated the broad investor community is to small cap stocks today. When we go back, and we can go back to 1993, essentially it's at all-time lows, other than for a short period during the internet mania in the 1990s. So, and why that's important, you may say, well, why is investors being at an all-time low allocation to small cap a good thing? Historically it is. It's a contrarian indicator, meaning that if you're under-allocated, again, there should be some reversion to mean we'll have more normal allocations over time. And as that money flows back into small cap, that can be good for us and our small cap strategies.
And one thing I'd add, Laird, is the markets were down something like 13.5% from market peak in February 2021 as of September 30. That's a 3.5-year period in which time our companies have actually grown pretty nicely from a fundamental standpoint. So multiple compression is what the result is. And not only do you have the chance to recapture multiple, but you should recapture the upside of all that growth from that 3.5-year period of time, as well as the markets revert back to the mean and people start to understand the value that is inherent in small cap growth.
Thank you, Randy. This is your time. We certainly want to get lots of questions, so just raise your hand. Someone will come with a microphone, and we look forward to your comments, questions, etc. Okay, what do we got? Where do we got? Over here. I'll get you next. Right back here.
Caps and the lack of new IPOs and Barron's capability with SpaceX and now Twitter to purchase non-public companies, is there any kind of a plan or a process where there's privately held small caps to be considered?
We're allowed to do that in our funds, and we've kind of chosen not to. Over the life of the Barron Small Cap Fund, I have owned some stocks that were private. There were public companies that were taken private, and I really don't think it's terribly appropriate for a public mutual fund to be owning private funds, other than in very, very special situations like the SpaceX and and the AI that you mentioned.
We've been seeing some private companies. We talk to private companies all the time. So something called an NDR, a non-deal roadshow. The brokers bring these companies around because they're probably grooming them to become public companies. We're seeing more and more of that, which is a good thing. It means the IPO market's about to open up. And so we spend a lot of time with private companies, not only for new merchandise, but also to understand competitive dynamics with private companies that can tell you a little more than public companies can with respect to things that we own.
Yeah, and I would just say quickly, the 25 calendar from the bankers we speak with and the companies that are coming through privately, seems like the IPO market will open up, which is a good thing for Barron because we are advantaged of seeing more of the flow of those companies, and we've met them privately, so we have a time advantage to do the work on them.
Got a question over here.
First of all, congratulations on your success on investing.
Thank you.
As an investor for 40 years for other people, I'd like to discuss a little bit about your process of the losers, things that don't work out, whether it's the FIGs or the auction auto company. What's your process of getting rid of the losers on a regular basis?
Who wants to take that?
It's really important for us to minimize losses, and unfortunately, we do invest in companies that we have high hopes for, and those hopes don't materialize. So the key is to try to understand that sooner, before it happens, and sell the stocks before they happen. But then if a company does disappoint or isn't performing or their future is not as bright as we thought it would be, when we come to the conclusion that that's the case, we just sell. I have this phrase that, we water our flowers and we cut our weeds. And it is very important in portfolio management to see things very clearly on troubled situations and sell. Ideally, you sell at a good price, but even if you have to sell at a bad price, it's the right way to manage money.
Any comments from you?
You want me?
Well, if the thesis, we have an investment thesis when we initially buy into a company, and if that thesis changes, then we want to make sure that we understand why it's changed. And a lot of times, and Laird says this all the time, if it's a when, not if, then we might keep the company if we believe in management and the turnarounds of whatever the incident is. But if it's if, or the strategy's changed, we're gonna sell, realizing that we've made a mistake, because it's very, very hard to recreate a new business plan on the fly.
See a question in the middle here.
Good morning. I would like to ask you, aside from the financial structure of a company's requirements to be in your fund, could you give us the specific core characteristics you look for a company to join your fund?
I'll start.
Sure.
Please weigh in. One critical aspect is the integrity of management. We like to invest with people. We meet with all the managements. We invest in those companies, look them eye to eye, and make sure we believe in their story. And typically, those businesses that are run with people who have a proven track record, who have delivered results, who stand by what they say and what they're going to do, and that our sustained interaction with those management teams over time enables us to make those judgments. So I think that's one criteria. Maybe add another criteria.
Yeah, we're in the small cap fund, what we're trying to do is invest in what we think are established, leading, winning businesses. We're not betting on the come that something's going to become successful, but we're investing in already successful companies. We believe, and ideally in companies that we think will remain successful for many, many years, because our goal is to buy them small and own them for a long period of time. So it's very hard to find businesses that are small, terrific, well-managed, and have a very strong long-term growth profile in which we think they can grow from small businesses to mid-sized to large businesses, and we can make very high compounded rates of return by owning them all that time. So it's really, to be considered for an investment in our fund, it's a real high bar to get over. And our approach is to own the good ones for a long period of time, so we don't need to find many new ones. We look for maybe 5 new stocks in a year on a portfolio of 60 stocks or so. So it's not, and the ones that we own, we cherish and hold them dearly, and we've made great returns by being in the right companies for long periods of time.
Do you guys like to add anything?
The only thing I'd add is, we want companies with big market opportunities that are not, fully penetrated, that, have late penetration at the outset. So we can kind of see going forward how big these companies can become, and kind of have a analytical basis for understanding what the growth and valuation should be over our 3 to 5 year investment horizon.
Yeah, let me just add one last thing. So to really answer that question, it's very subsector specific. As you know, what we do is more art than science, and every subsector has nuances to it that make it such that I'm looking for different things. So an industrial, just to pick a sector, an industrial, I'm always looking at margin, because at the end of the day, I can tell how special an industrial business is by the margins that it has, simply because if it's able to maintain those margins, it's a very competitive industry, industrials. If it has lower margins, then it's probably less special. If it has higher margins where they're facing a lot of competition, that means it's more special. It's just one example of one subsector, but we think about the nuances of all these subsectors and what makes something special within that individual subsector.
Let's go with Andrew over here on the left.
Yeah, thanks. On the heels of the last 2 questions then, is it a fair assumption that if you have something you're still holding, that you still feel that it's definitely a when, not an if? And specifically, I'm readdressing the FIGs issue a little bit. If you're still holding it, that's because you still believe it's a when, not an if for that.
We don't know, neither of these funds own FIGs, so that's, I won't comment about that particularly, but yeah, no, we also are, so some of the stocks in our portfolio, we're in the process of selling. So if you see a small position in our fund, that probably means that, either we're building it into something more substantial, or we're in process of having it exit the fund. And we try to be judicious about buying stocks cheaply and selling stocks dearly.
And just an example maybe of a when, not an if. I think everyone here on the stage and at Barron, it's a widely known name is Guidewire. Guidewire treaded water the stock for many years while they built this cloud migration of insurance companies. That stock has taken off this year after many years of waiting for that. So we were very comfortable that Guidewire was the de facto company to bring those insurance companies to the cloud. They are the number one player. It's a huge market. Finally, this year, they've gotten their act together, margins are up, and the stock is reacting accordingly. And so it was worth waiting around for that.
Yeah, I think one more example. I thought you were going to say Chart Industries, only because this has been, we own a company called Chart Industries, which is exactly in this camp. It was a when, not an if. Chart has a situation where we saw its backlog continuing to build, and yet its earnings every quarter were missing, and they were lowering guidance. And so there was this dichotomy of orders versus actual earnings. And so the stock was underperforming as a result of those earnings misses. And then this quarter, what you saw is that they missed again and lowered again, but the world is now of the belief that they can finally, they've reset the bar to a point where they can start beating numbers again, and the stock has reacted positively to that, even though you saw them miss. So I would put that as a good example of a company that was in the when category that we were patient with, and it seems like they've finally turned it around, and we'll see. Now you can come back and talk to me a year from now, because we'll know what has actually happened in the next 12 months.
Hope it works.
Jennifer.
Hi, thanks, guys. I appreciate it. I've been invested for a long time. I really like the discovery guys like you too, Cliff. So, great returns. But, I was wondering, have you ever thought about doing a long-short fund? I asked this because I participated in a seminar yesterday from a competitor where they've been very successful with a long-short fund. And their edge was that they felt they had great research. They know when a company's good and they know when a company's bad. And there's no one that has better research than you guys. You're the smartest guys I know. So, I was wondering, have you ever thought about a long-short fund?
That's a good question. Prior to joining Barron, I was a principal in a long-short hedge fund. And shorting stocks is a bitch, excuse my language. I mean, it's even though you have a lot of, you might have a research edge, it is a different skill set and a different mentality to succeed in that. So we've avoided, we've tried to keep our Barron product lineup very, very pure. We're growth, so we have only growth funds. We don't do bonds, we don't do value. And honestly, long short also, it would probably be a bucket that is something that we wouldn't do. Ron ran a hedge fund prior to, and honestly, Barron Growth Fund was a hedge fund, and it was converted into a mutual fund. And I think we'll probably, as a firm, stay pure to just this long only.
Yeah, I think Barron's reputation is being on, while we sit on opposite sides of the table, with management teams, we really are trying to align our interest with those businesses to see them grow and be supportive of that. So that would run counter to that. I don't think it would mesh with the culture.
I was going to say, before I started working with Cliff, my first year out of business school, I worked at a very successful short-selling hedge fund. They did long and short, but they were very successful on the short side. And I was shorting internet stocks in 1999. I remember being short e-toys. Which was a very interesting story. But after doing that for a year, I called up Cliff and said, I can't do this anymore. Can I come work with you on
Come on down.
Right.
Yeah, shorting stocks, you can lose infinite money you can lose on the short side. And I was at a hedge fund too. It's really tough.
Hey guys, question for Cliff and maybe anybody else. Can you talk about Vertiv and Eaton, for example, and can they operate very independently of NVIDIA's success? And what you think of the long-term projections when it comes to AI, the type of volatility we can expect from that, et cetera, because it is the number one position in, I believe, small cap?
Correct. I'll speak, and David, speak with me. Sure. Vertiv is an investment we made a handful of years ago. It's a leading provider of cooling solutions, primarily for data centers. The growth in data centers is exploding. Jeff Kolich talked about that in the last panel because of AI applications needing new and intense data centers, and therefore the growth for Vertiv's equipment is also exploding along with that development. It's very fresh, meaning this is a company that's an old school industrial that used to grow mid-single digits. Because of the growth of this end market, we believe its EBITDA or its revenues are going to grow 15 plus 20% organically. Its margins are going to expand, so therefore EBITDA is going to grow much faster. And therefore we really foresee a business that is in the front end of very, very rapid earnings growth, and it's been a wonderful stock as this is coming to play. And we believe it's, really kind of early stages. The difference now, though, is that the stock has been a great performer and a big winner for the small cap fund. Now trades at a real valuation, and also it's a real big sized position in our fund, and therefore we find ourselves reducing the position size a little bit to make it appropriate for its present valuation level and size it right in the portfolio. But we really do believe it's a company that's going to do $2 billion in EBITDA next year, and that EBITDA is going to grow to $4 or $5 billion off of that base, and therefore the company will be worth much, much more than it presently trades over time.
Yeah, and just on your NVIDIA specific, Vertiv serves many masters. They're serving Google, Amazon, so they are really at the center of this data center build out, not only on the capital and the first wave, but 30% of their business is on service, and that's where they differentiate themselves globally. They have technicians around the world that can come to your plant, do preventative maintenance, and the biggest customers are looking for that. And so that's an attachment to this build out that will be a long-lasting revenue stream at higher margins.
Let's go Jennifer, and then we'll go back.
I was also asking about Vertiv, so maybe mostly answered, but $45 billion market cap, ADP, it's like a 10 or 12 bagger over 5 years, but it still belongs in the fund because of what you just said. It's not, even though you're a small cap fund.
Yeah, that's our approach, which is, and having my and my family's money in the fund, it's what I learned, and Ron will talk about this too. When you find a great company, a big mistake is to sell it before you really have prospered or prospered to the full extent. So what I do or we do in the fund is when we find a small company, we're hoping to own it for a long period of time. If we do own it for a long period of time, its market cap is going to go up significantly, and we'll just trim back the size of the position so that it's reasonable and in the fund, and it also approximates what we think is the future upside in that stock. So the small cap fund, having done this now for 27 years, and luckily having a handful of these big winners go from little companies to big ones, if we still believe we can make great returns, we're going to own a portion of those. The largest stock in the portfolio is a company called TransDigm. We bought it 20-ish years ago. We presently own 100,000 shares out of a position that was originally 2 million shares, so I own 5% of what we originally bought. But I'm damn glad we've held on to that 5% because the stock continues to do really well, and we think it will continue to do really well. So, and we can fit all this in the mosaic or the puzzle and still be considered small cap if we just are careful that not to let these larger caps be too big in the market cap, to take the fresh money we get from trimming those positions or selling our losers or trading out of other things, buying new small cap stocks, so kind of recycling money into these small names, and then trying to be very honest or upfront with our investors about this is our strategy, this is our approach, and this is, and therefore, and we believe that approach of holding on to these great companies like Vertiv really is one of the main reasons the fund has done so well over time.
Right.
Laird and I have something similar in a company called Axon, which has been a 5-bagger for us since we invested a couple of years ago, and it's now over $40 billion. So that's part of the plan. Is just like Cliff, we we don't want to be forced to sell when you have great returns on the horizon, but at the same time, you got to balance the position out. Axon's a provider of tasers and body cams, but the key to that company is the software that connects it all, connects all the video on the cloud, and they're using AI now, and you'll hear more about that this afternoon, to basically automate report writing for police officers. Just amazing, high margin business that's growing on the top line and growing their margins.
I have a question back here.
Thank you. I think this applies more to Discovery, but with RFK being put into the cabinet and weakness in the vaccine stocks, do you see this as opportunity, as risk? Is it too early? I know you have some positions there.
Yeah, I mean, it's interesting. We don't know whether he'll be confirmed or not. We know he's made some public statements, but it's interesting. I think the market's misreading a lot of what he's saying as that he's anti-vax and anti-FDA. That's actually not true. I think he actually wants to get more drugs approved through the FDA, through humane use, and through other ways. On the vaccines, I think he just wants to make sure that his view is that they weren't tested enough. Now, whether that's true or not, I don't know, but it's not going to affect most of the holdings that we have in Discovery, even though the market is sort of overselling right now. And by the way, that's opportunity. But we have companies that are all over the spectrum with regard to healthcare and drug development. One of the companies that's kind of interesting is Stevanato, which makes glass vials that are used for biologics, whether they're standalone vials or used in cartridges with auto-injectors. And everybody knows how big GLP-1s or these weight loss biologics are. Stevanato is going to be a big player there. They're building out big plant capacity to supply some of the major biologics producers. And so there's a lot of ways to win there. And I really don't think that we're going to see a dip in overall drug development and production.
There's a question here.
So thank you for taking my question. I see you sitting on opposite sides of the stage, and I remember when the mandate for new discovery began. But I'm curious whether your analysts work in competition or collaboration as you come across opportunities that may benefit one or the other.
Oh, we're a team here.
Yeah.
Bit of background, thank you. And Laird and Randy were my two closest lieutenants before we launched the Discovery Fund. We basically launched it just going back in history because some of Ron and I, who run small cap funds, were really investing in companies that were a little more mature or a little larger and kind of not paying great attention to smaller businesses or more other exciting businesses. And we put to task these two young guys back then to kind of attack this area of fresher, newer companies, and they've done a bang-up job. And the concept has been stocks that they would buy, the companies maybe would grow up and they would migrate, some of those companies would migrate, or we'd want to buy them for the small cap fund, to the growth fund. That really has happened. There's cross-fertilization in which many of the stocks that we own, the Discovery guys are owning as well. And we find ourselves in communication constantly about, what we're looking at, but also importantly on the stocks that we both own together. We will have a different view potentially, but we'll each benefit from hearing each other's view. So this is teamwork. We'll come to different conclusions, have different portfolios, but we really work together. And I'm really so lucky to have these fabulous investors helping me run my fund and the whole in this great research group we have at the firm.
In the middle here.
Hi, good morning. We've seen a lot of growth in private equity where they're taking valuations to levels that are dramatically higher even than mid and large cap. How do you think that will affect the universe of names that you're considering? And then particularly for Discovery Fund, you guys have grown to $1.5 billion. At what point do you feel you might have to limit asset growth to really get the kind of size position you want on smaller IPOs or new names?
Hey, Arnie. It's good to see you.
Glad we fit you in, Arnie.
We don't feel like we're limited on an asset front. The sort of weighted average market cap of the fund is around $7.5 billion. We're in somewhat more liquid companies than we used to be. Some of the smaller companies have really struggled and been very hard to invest in. So we're avoiding sort of the micro cap area. And the fund has been as high as $2.25 billion, I think, at peak. Laird and I think that we have plenty of headroom there. And Laird, do you want to talk about private equity, or is there?
Yeah, the one thing I was going to add, the last couple investments that we've made is that, I was just thinking, we invested in an insurance company a broker that was sub $1 billion market cap. We invested in an industrial business. You can go back and see what company I'm talking about, but industrial business that was in the sub $2 billion market cap. So we're still finding those off the radar businesses. I mean, in the case of the industrial company, essentially has no research coverage. So we love finding those businesses where it's a great CEO, comes into a business, really reorganizes it, but still to this day they haven't been able to get research coverage. It's a company called Enerpac. But that's the kind of thing that Randy and I, while the market cap has moved up because we've had a lot of successful investments, I do think that at the core we love finding these off the radar businesses, and that's still what we do best. As far as private equity, taking things private, we had, how many takeouts have we had this year? Has it been 4?
3 or 4, yeah.
Yeah, I mean, we continue every year to have a nice portion of the portfolio that gets taken out. So I think it's a good thing for us that private equity is bidding, because the exact kind of businesses that they like to buy are the companies that we like to buy, which are, first movers in fast growing areas. Typically our companies are growing really quickly, but if you're a private equity firm or if you're a mid or large cap company, a lot of the characteristics that we look for in new investments are the same characteristics they're looking for in bolt-on acquisitions.
Thank you very much. That brings us to the end of the small cap panel. Appreciate all your questions. Appreciate your interest.
Thank you very much.
Thanks for investing.
Thank you.